Welcome to the Fastex Academy podcast, your go-to resource for cryptocurrency trading. In today's episode, we'll dive into the exciting world of crypto trading for beginners. We'll discuss essential tips and strategies for success, helping you navigate the complexities of this rapidly growing market. So, whether you're new to trading or looking to refine your skills, this episode is for you. Let's get started. Cryptocurrencies have experienced an unprecedented surge in popularity, attracting individuals with promises of quick and easy money. However, the reality is that many newbies need proper preparation and understanding to enter the market. The lack of knowledge often leads to significant financial losses. That's why it's crucial to approach crypto trading cautiously and equip yourself with the right knowledge. So, what exactly is trading? Trading involves buying and selling cryptocurrencies to profit from price differences. The difference between the buying and selling prices determines the profit or loss. Keep in mind that trading platforms charge commissions, which can significantly impact your earnings. It's essential to be aware of these costs to avoid unnecessary losses. One common mistake beginners make is jumping into trading without a solid understanding of the processes and practices involved. To mitigate this risk, it's crucial to study the theory behind trading and practice with small amounts of money before diving into more significant investments. Building a solid foundation will significantly increase your chances of success. Trading is a complex endeavor, and no one-size-fits-all strategy or magic indicator guarantees consistent profits. If such a method existed, everyone would be using it. However, each trader interprets market data differently based on their own analysis, experience, and personal traits. It's important to remember that trading is more akin to a game of chess, where strategy, tactics, and planning are essential, combined with the psychology of poker, where emotions can significantly impact outcomes. As a beginner, you'll likely experience a roller coaster of emotions while navigating the market. You'll go through various stages, including excitement, euphoria, shock, hope, panic, disappointment, and acceptance. These emotions are normal and often accompany market cycles. Recognizing and managing your emotions can serve as a secondary indicator for market phases and help you make more informed decisions. It's worth noting that becoming a successful trader often involves going through market cycles and learning from experience. While this can be a challenging process, it provides valuable lessons and helps you develop emotional resilience. As you gain experience, you'll gradually shift from making emotional decisions to relying on fundamental and technical analysis, as well as other relevant factors. Additionally, your attitude towards risk management will evolve significantly. Now, let's discuss the importance of deposit size in trading. Contrary to popular belief, the size of your deposit doesn't determine your success. Whether you have a $100 million deposit or just a few $100s, your attitude and trading strategies are what truly matter. It's not about throwing your entire deposit into a single approach and hoping for the best. Instead, consider dividing your deposit into smaller portions and develop a strategy that involves multiple assets and buying opportunities. Larger deposit holders often trade a limited number of cryptocurrencies due to liquidity constraints in the market. On the other hand, if your deposit is relatively smaller, it's advisable to choose less liquid instruments carefully. Assessing liquidity in the order book becomes crucial to ensure you can enter and exit the market without significantly affecting the current market price. Risk management is fundamental to successful trading. Here are some key recommendations to keep in mind. Never invest all your funds in a single instrument. Diversify your investments and avoid allocating your entire amount to a single coin or token. Avoid keeping all your funds in one place or trading on a single exchange. Be cautious about buying after a sudden price increase, commonly known as a pump. When a position is in substantial profit, consider using protective types of orders, such as stop loss, OCO, one cancels the other, or trailing stop, to safeguard your profits. Avoid re-entering an asset at a higher price than you sold it, unless you have a clear strategy in mind. Futures and margin trading are advanced tools designed for professional traders and not recommended for beginners. Lastly, never use funds for speculation or investment if their loss would significantly impact your quality of life. Now, let's explore the differences between spot trading and margin trading. Spot trading is often forgiving when it comes to beginners' mistakes, while margin trading can be hazardous. If you lack experience, it's strongly recommended to gain it on the spot market first. This approach allows you to understand how the market works and familiarize yourself with the various processes involved. In spot trading, you trade actual cryptocurrencies or tokens that you can withdraw to another exchange or wallet. Conversely, in futures trading, you trade cryptocurrency contracts, and you can't withdraw anything until you close the trade. It's important to note that exchanges may forcibly close positions or require you to do so, often resulting in losses.